You know how we often discuss broad investment landscapes? Well, today we're laser focusing on a specific opportunity that's landed on our radar, and it's got some really interesting angles. We're taking a deep dive into a particular property investment right now in Rincón, Puerto Rico.
Exactly. Forget the generic Caribbean real estate buzz for a moment. We've got the nuts and bolts of a specific deal right here, and our goal is to dissect what makes it potentially compelling for you.
Right. For those who might not be as familiar, Rincón is a true Caribbean hotspot. Think fantastic surfing, a lively tourism scene that pretty much runs year-round, and it's, generally considered a prime vacation destination. Plus, Puerto Rico has those Act 60 tax incentives, which, while we won't get into the nitty-gritty today, they create a generally favorable environment for investment.
And the information you've compiled gives us a real ground-level view. We have a detailed investment analysis focused solely on a property known as Puntas, alongside insights from PRVacationFund about their overarching investment strategy.
So, our mission today is to really pull apart this Puntas deal piece by piece. We want to understand the property itself, the very unique way it's being financed, the plans for upgrading it, the projected financial returns, and even how the profits are structured between the folks managing the investment and the capital partners.
Okay.
Think of this as your fast track to grasping the potential of a rather intriguing and, seemingly well-structured real estate play. Okay, let's unpack this, starting with the core asset, the Puntas property.
The Puntas property appears to offer a strong foundation right from the start. It's a 3-level multifamily building, meaning it houses several independent rental units situated in Puntas, Rincón. Critically, it's located directly across from Sandy Beach.
And that location is clearly a major asset. The analysis points out that being directly opposite Sandy Beach is consistently the top-rated aspect in guest feedback, earning a very impressive average score of 4.9 out of 5 stars.
Wow.
That level of positive sentiment is gold when it comes to attracting renters.
Precisely. That kind of consistently high praise underscores the inherent appeal of the location. The property itself sits on a sizable piece of land, 973 square meters, which translates to over 10,000 square feet. The building itself has a footprint of 1,728 square feet and is configured into 4 distinct units, offering a total of 5 bedrooms and 4 bathrooms. This provides valuable flexibility in how the property be rented.
But here's where it gets particularly interesting. This isn't a hypothetical situation. The property already has a track record of generating income. The previous owner reported an annual revenue of approximately $100,000.
Yep.
That works out to a gross yield of about 9.1%. Now, for those who might be newer to this, that gross yield essentially means that for every dollar tied up in the property's value, it's currently bringing in about 9 cents in rental income annually before you factor in any operating expenses. This gives you an initial sense of its income-producing capability.
That established rental history is a significant advantage. It provides a tangible baseline and reduces some of the guesswork associated with a completely unproven property. Now let's delve into the mechanics of this deal, particularly the financing, because it presents a rather unusual situation.
Unusual is an understatement. The purchase price was negotiated down to $1.1 million from a listing price of $1.2 million, so they started with a favorable negotiation. But the real head-turner is the financing. A substantial $950,000 of that purchase price is being financed directly by the seller at a 0% interest rate.
0%.
0%. In the world of real estate financing, that's exceptionally rare. This effectively gives the investors a 6-year interest-free loan, a significant advantage that immediately impacts cash flow.
It truly is an exceptional term. The deal involves an initial down payment of $150,000, which is about 13.6% of the purchase price, and was funded by investors in PRVacationFund. Following that, for the next 6 years, there will be monthly payments of $3,000, totaling $36,000 per year. The critical point with 0% interest is that every single dollar of those monthly payments goes directly towards reducing the principal balance of the loan.
So for 6 full years, they're consistently reducing that $950,000 debt without any of the typical interest charges eroding their cash flow. That's a massive immediate benefit.
Precisely. However, it's important to note that there is a balloon payment of $734,000 due at the end of that 6-year period.
Ah, okay. The catch.
Right. This is a common feature in seller financing agreements, meaning a significant lump sum will be owed at that time. The analysis indicates that the strategy is to implement value-enhancing renovations to boost the property's income and overall market value, thereby making traditional refinancing a viable option around year 5 to cover that balloon payment.
Okay, so the plan is to capitalize on this incredible interest-free period to improve the property, increase its value and income generation, and then refinance before that large payment becomes due. That seems like a strategic approach.
It does.
Now, let's shift our focus to the environment where this property operates, Rincón itself. What does the market data tell us?
Well, the market analysis paints a picture of a robust and expanding short-term rental sector in Rincón. We're looking at approximately 1,696 active listings with a solid average occupancy rate of 60%, which has actually seen a 4% increase compared to the previous year.
That's pretty good growth.
Yeah, and the average daily rate for rentals is $251.90, also showing a positive trend with a 3% year-over-year increase, and the average annual revenue per listing is around $29,800, reflecting a similar 3% growth. These are all positive indicators signaling healthy demand.
So it's not just anecdotal evidence suggesting Rincón's popularity, the underlying market data supports it. And the Puntas property, given its location and existing performance, appears to be well positioned within this market.
Absolutely. The prime beachfront location provides a significant competitive edge, as we've already highlighted. The fact that it's a multi-unit building offers valuable operational flexibility that can rent out individual units or the entire property depending on demand.
Right.
The established rental history confirms its existing appeal, and the planned renovations offer the potential to significantly elevate its position within the market, likely allowing for premium pricing. Furthermore, the mention of Act 60 tax incentives, even without a detailed explanation, suggests a favorable financial context for property investors in the region.
The analysis also touches on the seasonal fluctuations in demand, which is a critical consideration for any vacation rental market.
Yes, understanding these seasonal trends is essential for optimizing revenue. Peak season in Rincón appears to be July and August, characterized by very high occupancy rates in the 90–95% range.
Wow, really full.
Yeah. There are also shoulder seasons in the spring and fall, and a low season typically in September and October, although even during this period, occupancy remains relatively strong at 70–75%. This kind of detailed insight allows for informed decisions regarding pricing strategies and marketing efforts throughout the year to maximize income.
And they even provided a comparative analysis, placing Rincón's market metrics alongside those of other areas in Puerto Rico.
That's right. What's particularly insightful here is how Rincón compares to destinations like Dorado and Rio Grande. While Dorado might exhibit a slightly higher average annual revenue per listing, Rincón boasts a stronger average occupancy rate and a comparable average daily rate, all with a significantly lower number of total listings.
Less competition, maybe?
Potentially. Rio Grande, on the other hand, shows lower figures across all these key metrics. This comparison suggests that Rincón offers a compelling balance of robust demand and strong pricing potential within a less saturated market.
Okay, so we've established that the property is in a desirable location within a healthy market and benefits from a truly exceptional financing arrangement. Now, what's the strategy to enhance the property further and achieve those projected returns? Let's delve into the renovation plans.
Okay. The renovation strategy is structured as a 3-phase approach with a total budget of $150,000. The core principles guiding this strategy are to capitalize on the existing location advantage, significantly improve the guest experience, and ultimately maximize the return on the renovation investment itself.
That makes perfect sense. You want to leverage what's already working while strategically upgrading to increase appeal and revenue. So can you walk us through the specifics of each phase?
Sure. Phase 1, with an anticipated completion within the first 3 months and a budget of $50,000, is focused on making immediate, impactful improvements. This includes optimizing the ocean views, perhaps with the installation of glass balcony railings and strategic landscaping.
Nice.
They also plan to enhance the property's curb appeal and the entry experience, upgrade the outdoor living spaces with features like an improved outdoor shower and lounge area, and refresh the interiors with fresh paint, updated lighting and plumbing fixtures, and new furniture.
So focusing on the aspects that create a strong first impression and directly impact guest enjoyment of the location. First looks matter.
Exactly.
Yeah.
Phase 2, budgeted at $25,000 and planned for months 4 through 6, shifts towards establishing a strong brand identity and enhancing the overall guest journey. This involves creating a distinctive property identity, complete with a name and branding elements, developing a robust digital presence through a professional website, high-quality photographs, and virtual tours.
Oh, yeah, the photos are key.
Absolutely. And integrating convenient technologies such as smart locks and reliable high-speed Wi-Fi. They also plan to curate amenity packages, including welcome gifts and beach equipment to further enhance the guest experience.
That digital presence piece is absolutely crucial for short-term rentals in today's market. The majority of bookings happen online, and compelling visuals and a user-friendly website can be the deciding factors for potential guests.
Absolutely. Finally, Phase 3, with the largest allocation of $75,000 and commencing after month 6, targets more significant capital improvements. This includes upgrading the kitchens with higher quality countertops and new appliances, fully renovating the bathrooms with modern fixtures and finishes.
The big-ticket items.
Right. And expanding the outdoor amenities, potentially by adding a rooftop terrace or a hot tub to further leverage that prime location.
Those sound like the types of upgrades that can truly justify a higher average daily rate and attract a more discerning clientele. Speaking of financial returns, the analysis presents some quite compelling figures regarding the return on this renovation investment.
What's particularly noteworthy is the projected 74.9% increase in annual revenue, jumping from the current $100,000 to an anticipated $174,900 following these renovations.
Wow, a big jump.
It is. This translates to a remarkable 49.9% annual return on the $150,000 renovation investment, with a projected payback period of just 2 years. Those are highly attractive numbers for any value-add real estate project.
And they're anticipating significant improvements in those key performance indicators we discussed earlier, the ADR, occupancy.
Yes. The expected outcomes include a 20–30% increase in the average daily rate compared to the overall market average in Rincón, an occupancy rate of 65–70%, which is 5–10% higher than the current market average, and a target guest satisfaction rating of 4.8 stars or higher. These are ambitious goals, but seem achievable given the property's inherent advantages and the strategic nature of the planned upgrades.
Okay, so we have a well-located property with amazing financing and a solid market, coupled with a thoughtful renovation plan that promises significant returns. Let's get into the specifics of the financial projections. What kind of cash flow and overall returns are anticipated here?
Okay. The projected annual revenue post-renovation is $174,900, and the analysis provides a detailed breakdown of this figure by each of the 4 unit types, demonstrating a granular understanding of the income-generating potential of each.
Good detail.
Yeah. They've also developed a very comprehensive breakdown of the projected annual operating expenses, totaling $102,725, which represents approximately 58.7% of the total revenue. It's worth noting that this includes a property management fee of 20%, which is on the higher end of typical rates, suggesting a potentially conservative estimate for expenses.
A slightly higher management fee could indeed provide a buffer in their projections. So, after factoring in all those operating costs and the $36,000 in annual mortgage payments to the seller, what's the projected net annual cash flow?
After deducting those operating expenses and the annual payments to the seller, the projected net annual cash flow is $36,175. This represents the cash the investors and the operating entity would have remaining after covering all operational costs and the debt service to the seller.
So that's the annual profit the deal is expected to generate. And how does that translate into returns for the investors providing the initial capital?
The analysis highlights a projected cash-on-cash return in the first year of 21.3%. Now, for those less familiar with this term, cash-on-cash return essentially looks at the annual cash income generated by an investment relative to the amount of actual cash initially invested.
Got it.
Over the 6-year period of the seller financing, they project a total return of $917,468. This impressive figure includes both the cumulative net cash flow generated over those 6 years and the anticipated equity buildup in the property through principal paydown and potential market appreciation.
That's a significant total return figure.
It is. They've even provided a detailed 6-year cash flow projection, illustrating how the returns are expected to grow over time, taking into account the anticipated refinancing in year 5 to address the balloon payment in year 6.
Those are certainly compelling potential returns for investors. Now let's talk about the entity behind this venture, PRVacationFund. What's their business model, and how do they typically structure their partnerships with investors?
PRVacationFund describes their primary focus as investing in short-term vacation rental properties, specifically in Puerto Rico. They generally emphasize a strategy of conservative, all-cash acquisitions and a rigorous property due diligence process. However, the Puntas deal is an exception. utilizing seller financing.
Right, the 0% financing.
Exactly. Their partnership model typically involves offering equity partnerships, where investors contribute capital in exchange for a direct ownership stake in the property.
So unlike a traditional lending scenario, the investors become part owners of the asset.
Correct. And this brings us to the crucial aspect of the profit split. For this particular Puntas investment, there's a clearly defined 50-50 internal profit split between PRVacationFund, acting as the operating entity responsible for managing the property and executing the strategy, and the investor group.
Okay.
This 50-50 split occurs after all operating expenses and the $3,000 monthly payment to the seller have been accounted for, resulting in the net operating profit we just discussed.
Okay, so after all the necessary expenses are paid, the remaining net operating profit is divided equally between Pierre Vacation Fund for their operational role and the investors as a return on their capital.
Precisely. So with a projected annual NOP of approximately $36,175, this would translate to roughly $18,000 annually allocated to Purification Fund for their management and execution, and an equal amount of around $18,000 available for distribution among the investors based on the size of their individual investments.
And it's important to reiterate that beyond this annual share of the cash flow, the investors also stand to benefit from their proportional share of the equity that builds up in the property over the 6-year financing term.
Right.
This equity growth happens through the principal being paid down on the mortgage each month, and any potential appreciation in the property's market value by the time of sale or refinance.
That's a critical element of the total return for the investors. Their financial benefit isn't limited to just the annual cash distributions. It also includes their increasing stake in the underlying asset's value.
Now, no investment comes without potential downsides. What are some of the key risks that the analysis has identified in this particular deal, and what strategies are proposed to mitigate those risks?
Well, the analysis does a commendable job of outlining potential challenges. The most significant one, as we discussed earlier, is the $734,000 balloon payment due at the end of the 6-year seller financing period.
The big one.
Yeah. The primary mitigation strategy here is to proactively begin the refinancing process well in advance, ideally around year 5, and to ensure the property is maintained in excellent condition to maximize its appraised value at that time. They also suggest the possibility of considering a partial sale of equity to new investors if needed to cover the balloon payment.
That proactive approach to refinancing seems essential. What other potential risks were highlighted?
Another key risk is the inherent reliance on achieving the projected occupancy rates for the short-term rentals. Actual performance could certainly fluctuate based on market conditions and competition.
Sure, projections are projections.
Right. To mitigate this, their strategy includes implementing a dynamic pricing model that adjusts rates based on demand, developing attractive packages for those shoulder seasons to boost occupancy, listing the property on multiple online booking platforms to maximize visibility, and even considering offering longer-term rentals during the traditional low season if necessary to maintain income flow.
It's prudent to have those alternative strategies in place to address potential variations in demand. Given Puerto Rico's geographical location, I imagine the risk of natural disasters is also a significant consideration.
Absolutely. The risk of hurricanes and other natural disasters is explicitly addressed, with a proposed mitigation strategy involving obtaining comprehensive insurance coverage to protect against potential damages and income loss.
Crucial.
Definitely. They also plan to incorporate storm-resistant upgrades where feasible during the renovations, develop a detailed emergency response plan to ensure guest safety, and maintain adequate financial reserves to cover any potential operational downtime following a natural disaster.
And what about risks related to the dynamics of the short-term rental market itself? More competition, perhaps?
They acknowledge that an increase in the number of available short-term rental properties in the Rincón market could potentially lead to increased competition, which might impact both occupancy rates and average daily rates. Their strategy to address this involves focusing on clearly differentiating the Puntas property through the premium amenities and high level of service planned in the renovations, developing a unique selling proposition that highlights its advantages, and building a direct booking channel through their own website and marketing efforts to reduce reliance on third-party online travel agencies and their associated fees.
Smart. Avoid those OTA fees.
Exactly. Finally, they also mentioned the potential risk of changes to local short-term rental regulations or any modifications to the Act 60 tax benefits. Their mitigation plan here involves staying well-informed on all local and national regulations, maintaining full compliance, and actively building relationships with local officials and hospitality industry associations.
It's reassuring to see that they've proactively considered these potential challenges and have outlined specific strategies to address them. I believe they also conducted a sensitivity analysis on some of the key financial variables.
Yes, they did. They ran multiple scenarios to assess how the projected annual cash flow and cash-on-cash return would be affected by potential variations in critical factors such as occupancy rates, average daily rental rates, and operating expenses.
And
Encouragingly, the results of this sensitivity analysis indicate that even under some less optimistic assumptions, the investment is still projected to maintain positive cash flow and deliver attractive returns, suggesting a degree of resilience in the financial model.
so, having thoroughly examined the property, the financing, the market dynamics, the renovation plans, the detailed financial projections, PR Vacation Fund's business model, and the identified risks along with their mitigation strategies, what is the overall recommendation put forth in the analysis?
Based on their comprehensive evaluation, the analysis strongly recommends proceeding with the acquisition of the Puntas property at the negotiated purchase price of $1.1 million. They emphasize the combination of the exceptionally favorable purchase terms, particularly the 0% seller financing.
Can't stress that enough.
Exactly. The property's prime beachfront location and the significant value-add potential that can be realized through the strategic renovation plan as the primary drivers for this positive recommendation.
They really underscore that 0% interest financing as a game-changing element of this deal, don't they?
Absolutely. When you couple that unique financing structure with the inherent desirability of the beachfront location, the operational flexibility offered by the multi-unit configuration, the proven strength of the Rincón short-term rental market, the potential benefits of the Act 60 tax incentives, and the clear opportunity to enhance the property's value and income through targeted renovations, it creates a very compelling investment profile indeed.
Yeah.
The analysis even includes a detailed implementation roadmap outlining the key phases from acquisition to ongoing operations.
It certainly presents itself as a very well thought out and thoroughly analyzed investment opportunity. So, as we bring this deep dive to a close, what would you say are the most crucial takeaways for our listeners regarding this Puntas property investment in Rincon?
I think the key takeaways are, first, the inherent attractiveness of the Puntas property itself, particularly its coveted beachfront location. Second, the truly exceptional 0% interest seller financing, which provides significant financial leverage and reduces initial risk. Third, the substantial potential for revenue growth and enhanced profitability through the well-defined three-phase renovation strategy. And finally, the transparent 50-50 profit-sharing structure established between PRVacationFund and the investors after all operating costs and the debt service to the seller are covered.
It's a compelling combination of a property with a solid existing performance and a clear pathway to significant upside potential, all situated within a well-regarded and continuously growing vacation rental market. It certainly sounds like an opportunity worth further consideration for those interested in this space.
It does indeed. And considering the unique financing structure and the clearly articulated plan for enhancing this beachfront property, it prompts an interesting question. What other similar opportunities might exist for astute investors in other emerging vacation markets? What other underutilized assets in prime locations could be transformed with a strategic vision and creatively structured financing? That's a thought for you to perhaps explore further.
A fascinating question to consider. And if this deep dive into the Puntas investment has sparked your curiosity, we certainly encourage you to delve deeper. Perhaps research the short-term rental market in Rincon on your own, or explore the concepts of real estate syndication and equity partnerships, all building upon the insights we've uncovered in our conversation today. Thanks for joining us for this deep dive.